So thank you all for joining. My name is Ryan Walter. I'm the managing director at ProCFO Partners, and I'll be your moderator for the discussion today. And while we're going to go through two hypothetical situations from a buy side and a sell side, you're encouraged to ask your own questions to the panel too. So please, I'll be making sure there's time, but if you want to ask anything, we'd be happy to do that. And I'd like to start by introducing our panel. They've moved on me now, so I'm going to have to redo it. They weren't sitting where they said they were going to sit before. So on my far left, your far right, is Marc Snyderman. He's a partner with OGC Solutions, a law firm specializing in helping small and medium-sized businesses with virtual legal departments. He is also the co-founder of PREP4M&A, as well as entrepreneur, content creator, and an angel investor. On his right is Sasha Lalite, and she is the CEO and founder of MetaViable Solutions, a fractional COO and consulting firm. She's also the co-founder of PREP4M&A, which provides M&A advisory and integration support to companies looking to buy or sell, driving them through the process to successfully close the deal. Then we have Mary Soldano. She's a national SBA 7A lender focusing on financing mergers and business acquisitions through the SBA's 7A program. For over a decade, she's been dedicated to helping small businesses get access to capital. Finally, Martin Cunningham. He is a seasoned financial executive and CFO with ProCFO Partners, who provide part-time fractional CFOs to organizations who don't want or need a full-time CFO, but want the benefit of a strategically minded CFO to help guide them through success. So what I'm going to do as we get started here is go through the hypotheticals. We'll start with the buy side. We're going to do about half our time on the buy side and then half our time on the sell side. So I'm going to start with Company Alpha. We're really good with naming. If you can guess what the next company is going to be called, you don't get any credit, but you know. So Company Alpha is an engineering services company that grew from $5 million in revenue to $15 million in a 4-year period, but has remained flat in revenues, let's say, for about the past 3 years. They're looking to grow and have determined that an inorganic strategy to acquire a new company is the best path forward. Now, they've identified a target company that does similar work as they do, but it handles different segments, municipalities and private land developers. It does approximately $7 million in annual revenues, and they have about 20 staff. Okay. So we're going to ask the first question of our panelists. So let's start with the due diligence. What should I expect or be looking for, and what consideration should be given towards integration as part of this process? You want to go first?
Good morning, everyone. So when it comes to due diligence, we're really looking at the process of investigating, right, reviewing, analyzing the potential deal and the investment opportunity. So we're also looking towards our acquisition strategy and evaluation, what type of structure we're going to be doing, and what have you. So it's really important to take a look at the strategy. I usually focus also on operational models. So we want to take a look at, is the target company, what type of the operational model do they have, and what would this acquisition look like? Also taking a look at what the current buyer's operations model is. Taking a look at procurement, logistics, supply, how are their efficiencies in these areas? Looking at organizational design is also a big component. We also work very much with all the other interdependencies. So legal, finance, operations touches everything. So a lot of times we're helping to drive decisions forward. What does our communication strategy look like? Making sure that we don't get hiccups when it comes to these things, because we're planning, right, for more of that successful integration. So it's very important to be transparent when we're looking at documentation. We're doing extensive documentation review. Operationally, we're more focused on policies and procedures. We work with legal to look at employee handbooks. What are standard operating procedures? What would this integration look like? And how do we make this integration successful if we do acquire the business, because we want to avoid any bottlenecks or disruption in business once an integration happens. So a lot of times we might set up a project management sort of office to make sure that the decisions are aligned along all the different stakeholders. making sure also that in document review, documents are secure. We're also compliant with regulatory and industry standards when it comes to the specific industry that we're dealing with. So all of this will help as we move forward.
Mark, you have a comment?
Yeah, I'll take it. Hey, how's everybody doing today? So I'll give you the legal side of due diligence, which obviously there's a whole lot to it, right? There's a lot of different pieces, but let's focus a little bit on the fact that it's an engineering company in the hypothetical with doing municipal work. So there's a lot of things that, would change the way you're looking at it from a legal perspective and the operational side in terms of what that business is doing. So I would say, like, when you're doing due diligence, you got to kind of get into the business and the industry. You can't just look at it from the high level of, okay, there's a bunch of contracts, there's legal side, corporate side stuff, which is all the basic stuff, right? The stuff that you really want to figure out is how do you get into the business itself and understand what that business is doing and what pieces there are that are really important. So if you're doing I've done a deal for a municipal engineering services firm, so I might have had something to do with the hypothetical here. But when you're looking at those kind of companies, they have very different ways of doing business than a traditional civil engineering firm that may be just doing public, contract work for private developers. They have you have to look at how long have they been in the municipalities, right? How deep are they in the municipality? And then you also got to look at conflicts, right? Because you might have conflicts if you're buying that business. Do you have private developers that have been doing business in those municipalities? And now you may have created a conflict because now the civil engineering firm that did the sewer lines and designed all the water lines, you're now trying to build a community in there. So there's all those kind of things that come up, and good due diligence isn't just looking at the company and the contracts and saying, okay, these contracts are 5 years, these are 2 years. It's another piece to it, right? So you got to get to that next level. And that's where, I always say probably the best thing you can do when you're going to go buy or sell a business is find professionals. Now, I know that sounds self-serving because I am a professional in the M&A industry, but it's a very true statement. And the more deals you get involved with, the more you understand that knowing people that actually are in the business and have done it, they can help you find things that you would have never seen. And the differential between finding something in due diligence and not finding it, especially in the structure of deals, which Martin can talk about in a bit, is there's a lot of earn-out in deals these days. There's a lot of, seller notes. So if you're holding paper and you're a seller, you better know, you want to make sure the buyer understands what the business they're buying is and that they're going to be successful. So, due diligence is really, it is the critical piece of when you're doing the transaction.
Martin, anything you want to add?
Morning, everybody. Thank you. Sure, it's on. So from the financial perspective, to me, it starts with the due diligence process as it relates to the strategy. I think in considering a deal like this, you're adding a customer's profile or additional segment of a customer type to the operations and overall growth strategy to the organization. So obviously from a CFO's perspective, that's top line growth. Is there cannibalism? Are there issues and conflicts that Mark alluded to? The due diligence also really lends to the underlying work to determine whether or not the valuation, or to determine what the valuation is, and then whether or not the valuation is an agreeable price point for both the buyer and the seller. Without that, there's no deal. As far as the specific steps relating to the due diligence, the panel has spoken to a lot of the steps that the CFO would generally be participating in and coordinating with and collaborating with, in addition to gathering documents from the seller for the financial statements, the customer and vendor contracts, employee contracts, statements, standard operating procedures, manuals, and other loan and debt covenants to determine whether or not the company that you're buying or targeting is profitable, generating cash flow, if there are any pressure points or any red flags that might come up in the process. So, the role of the CFO really kind of helps lay all that stuff together, develops a game plan, and just kind of, puts together a conversation and works with the ownership to really provide good, sound advice in those areas to help support a good deal.
Great, thank you. Just want to check to see before I ask the next question if there's any questions the audience would like to raise. Okay. So as we look towards the actual acquisition, what should we be thinking about when it comes to valuation? And what information would be helpful to know? You want to start, Martin?
To keep hearing me. Depending on the industry, and engineering services generally has their own way of valuing companies and targets. A lot of them are multiples of either top line revenue or EBITDA. And most of you might know EBITDA, for those you don't, it's earnings before interest, taxes, depreciation, and other amortization of intangibles like patents and copyrights. And when you're doing your due diligence, getting kind of full circle here, you're going to help identify as the CFO how accurate the number is and how you can distill those numbers down to the correct metrics first, and then of course the appropriate valuation, absent or in addition to any goodwill that's proposed in the offer.
Thank you. Yeah, so similar to the documentation is everything, especially when you're requesting financing. So oftentimes I'm often pre-qualifying sellers for SBA financing. So, hey, if you find a good buyer, you can qualify for a $4 million SBA loan. So then that's bridged with either seller financing or buyer equity down into the project. And so in that EBITDA number, I can only include what we can actually document via tax returns or some type of documentation. So if you're helping prep a company to sell, and let's say they've put their boat payments through the business the last 3 years, they have nothing to back that up, I can't use that. So as you're prepping them, say, all right, let's go through all your paperwork. What can we show to document that this is true EBITDA and that you don't need these funds to operate the business? That's the biggest thing that I see. And sometimes, there's another $100,000 that could move the needle on a debt service that they have no documentation for. And so I'd let this buyer know, listen, we can bridge this in a seller note. You may trust the seller, but I cannot include it unless there is some type of documentation. So that's just a big one. I think whether you're financing SBA or financing regular conventional financing or even private equity firms, depending on how detailed they're getting these days, like documentation is everything.
Yeah, so when you're, on the valuation side, you're always trying to figure out trying to help the client understand where is the value and what is it as part of your strategic initiative, right? So because it'll change the whole value for them based on where does it fit in their strategy, right? And that's part of, what we try to tell people is when you're looking to buy or sell, you want to try to start this process well ahead of time. It's not just a decision you make today. Hey, I'm going to go buy a business, and I own a business, and I'm going to buy another business and merge it in. You got to really think through what is it that you're going to go look for. What's your acquisition strategy, and that'll help drive the valuation for the business. Because obviously, as a strategic, you might be willing to pay a little more for that company that you find and be able to outbid somebody. And it is a buyer's market overall right now. So there's a lot. You can go find a lot of businesses. And if you look at the statistics, I don't know them offhand. I'm gonna kind of just throw, but there are a ton of businesses that are coming up for second generation right now, and there's not a lot of second generations that want to own those businesses in the small mid-sized market. So, and that's kind of where most of us play, is in that, and that's what we're talking about, right? These small mid-sized companies that are all going to be coming up for sale and people looking for exits. And how do you make sure that as the seller, you have the greatest exit possible? You can maximize your valuation. And on the buy side, obviously you want to try to get the valuation down as much as you can so that you're paying the right price. But you also are willing to pay a good price if it's something that fits in your long-term narrative and your long-term acquisition strategy. So those are just considerations as you start to think about things. Really, I can't stress enough that there has to be a strategy for what you're doing, and that'll flow through to your operational side, through your finance side, And on the finance side, I mean, you do see, I don't know, it's a good question for you, Morton and Mary. Like, how much are you seeing quality of earnings reports being necessary and things like that? Because, like, you know, you see, like, you know, a small business, you guys, if you're running a small business, you know, you try to run your books as well as good as you can. You're not getting audited. You know, at best, you're getting reviewed statements, but probably not even reviewed statements. Like, how much are you seeing a need to go to quality of earnings reports?
Honestly, for me, it depends on the sophistication of the buyer. So because most of our deals are smaller, our max loan is $5 million. I see maybe 1 out of every 10 deals has a quality earnings report. So that may be different for you, but a lot of them are just looking straight to tax returns and the internally prepared statements because they're smaller transactions. So we don't really see the need for it. We do still get a third-party business valuation though, which is like a mini quality of earnings, I call it. So it's still like a 60-page document that goes through all of the business's financials. They interview the buyer and everything, but it doesn't have as much meat to it. So I honestly don't see them as much because of the smaller transactions.
Yeah, I mean, from my perspective, I tend to work in the smaller space, so I don't see quality of earnings nearly as often, and probably less often than probably is necessary. But yeah, the third-party valuation engagements and valuation reports are becoming much more common from what I can see. Obviously, because you know there's a need to validate and document what the professional opinion is for evaluation. But yeah, I'm seeing that a lot more often.
So there are a number of actual variations when it comes to shaping and funding a deal. You know, so what financing options are there out there? Are there qualifications, and like, what's the impact, you know, when it comes to kind of the difference of this being a stock versus an asset deal? You start, and then Mary.
I guess that's me. You know, the first, obviously, one of the big considerations when you're going to buy something is, should I be looking to buy this just by the assets of the company, or should I be looking to buy the stock and buy the whole company? Or, you know, in most cases, you're using the term membership interests because a lot of people are using LLCs, so it's not stock anymore. But really, it's equity. It's the same thing, just called something different. There's, you know, we can go into legal reasons why they're not the same thing, but overall, it's equity, right? So when you look at an asset deal versus a stock deal, there's a big difference. The biggest difference that you're looking at is the liability side of it. What are you buying when you buy the company? So if I'm buying an engineering services firm, like in our hypothetical, and they have done, you know, they have 15 years or 20 years of historical work they've done. They've done dam rehabilitations. They've done design on dams. They've done sewer construction design, and I buy that company. Now, if I buy the stock of the company, I'm buying that liability, right? I'm buying everything that has to do with that company, their history, their liabilities. It's all carrying through to the transaction, right? So now you're going to have a whole piece of the transaction and the transaction documents that has to deal with what's the indemnity look like? How am I going to make sure that if there is a claim, I'm going to be able to cover that claim? And it's going to get covered by, you know, so I paid a bunch of money to this guy. I bought his business. He's off on a boat somewhere in the Caribbean. And now I have this lawsuit that just came in because the design of the dam failed and, you know, it flooded, you know, 2,000 acres of farmland. And, you know, it ruined everybody's crops. It's terrible, right? So I have to look at that and figure out what am I gonna do with that as part of the transaction? So when you're looking at stock deals, that's a big consideration. If you just want to buy the assets, you can buy just the assets out of the company, right? So you're basically going to leave a shell sitting there, but of course now that shell has no income, nothing to it, but at least I didn't buy the liability. But if that liability comes, believe me, they're still coming after you because you bought the business. So you got to make sure that in the asset purchase agreement, you're dealing with that indemnity as well. So you have to deal with it either way, but it's a matter of how much did you really pick up as part of the transaction.
And in terms of financing, I wonder how many times we're going to say SBA today. It's going to be a lot. And documentation, but SBA, and keeping track of all your docs. So SBA, I mostly finance probably 90% of my lending is in business acquisitions, whether that's mergers or a new buyer coming in or key employee buying the business that they've been working for. And this has been the stock versus asset conversation has been happening a lot lately with some of the SBA's new rules. And so I've actually seen probably more stock purchases in this past year more than ever before, because typically people are very afraid of them for all the reasons Mark has listed out. You need a very good attorney for them. But now the SBA allows for partial changes of ownership. And so what that means is somebody could come in and buy like 95% of a business. Seller retain 5%, you could buy that 5% out at a later time. They don't guarantee it. But if you do a partial change, it must be a stock purchase, because you can't do that in an asset purchase. You can't create a whole new entity and then buy it, because it's not really a stock purchase. It's trying to get around it. So in terms of SBA, it must be a stock purchase if you're doing a partial change. So there's lots of pros and cons to that. One of the biggest pros that we've seen recently is in terms of licensing. And so if they are going the SBA financing route, most lenders cannot close that loan unless licensing is in place prior to or at closing. So in an engineering firm, somebody has to be licensed, right, to be able to do that work, whether that is a key employee with possibly an employment agreement or the buyer or the seller. So if the seller is the only person who's licensed and you're buying them out 100%, that license is going away the day after closing. You can't legally operate. So like our main job is to make sure they can legally operate post-closing so that they can repay their loan. That's where the stock purchases have come in handy. And so we just closed on a pool company acquisition down in Maryland where they needed a license. And so it was 99%. It's going to take our new buyers about 6 to 9 months to get that license officially. So the seller was able to retain the 1% and they can buy that out at a later time. We've seen people kind of, you increase the purchase price by 1%. There's ways around that so that the seller still gets what that hopeful cash is at closing. And you're basically then paying that seller for their license. But it must be a stock purchase. And so there's lots of pros and cons to that. I'm sure we all are aware of some of those in this room. And then on the financing side, the biggest thing that we are looking at is cash flow of the business that you're buying and also the management experience. So who is buying this business? Do they have the qualifications that they need to be able to run it properly? And so sometimes keeping the seller involved, whether that's in a partial or keeping them on for at least a year in like a consultant capacity, is a huge plus, because then the seller is going to care about the success of the company because they want to get paid back, right? They want that extra 1%, or if they're doing a seller note, they want that seller note repaid. So I know there's lots of sellers sometimes are like, I definitely don't want a seller note on this deal, but it does work and it helps in the lender's favor a lot too.
Thank you. You have something?
Yeah, just one more follow-up on that. Just from the hypothetical standpoint, when you're buying an engineering firm with a lot of contracts, if you're buying a stock purchase, you can assume those contracts. They won't have to be novated, and it's a big change. So when you're looking at government contracting firms, any firm that has a lot of contracts in it, stock purchase versus asset purchase becomes a very interesting conversation, because you may be able to buy the company and assume a lot of contracts without having to go through a lot of process. That if you were buying the engineering firm and you're going to sort of buy the assets, you may have to go through a lot of approvals. The contracts may even novate. They may shut them off, and you have to restart those contracts. So that's a big consideration when you're looking at different types of businesses.
Great, thank you. So this isn't just about the numbers, no matter how much we hear that, it's only about the numbers. So what other factors from things like HR, culture, leadership, that perspective should be considered?
So you should definitely be thinking about your people management and your organizational design. So you have your buyer and you also have your acquisition that's happening. So what is the current organizational design and roles within each of the companies? And how do you plan to kind of merge those two cultures together without scaring people off? So also making sure that what needs to be kept confidential at certain phases is kept confidential, who is privy to what information. Organizationally, what does the buyer's current design look like? What are people's clear roles and responsibilities? And then for the company that they're acquiring, what do their roles and responsibilities look like? When we end up acquiring that company, do we have to lay off anybody? Are there going to be new roles that we have? What is that going to look like? Because you kind of have to have your ducks in a row before you're communicating those changes to your people. How are we going to keep our most talented people? And what types of incentives currently exist that we have to consider, right? Also legally, and what type of incentives do we maybe want to put on the table? Taking a look at compliance, employee contracts, like you said. So those types of things. Also, if people also already have current investments, what does that look like? So that there's not any qualms later on. And culturally, that's another consideration as well. I've worked with companies where, people are used to different things. So how are we now going to look at our policies and procedures? What are the gaps that we see when we're reviewing the documentation? And how are we now going to conduct business? And then how are you going to communicate those changes to employees? So once you actually do policies and procedures, how do you communicate those changes? You have to also invest in your people. So things such as trainings, having meetings at the right time, at the right cadences, that all comes into play for communication methods. And so that helps when you're doing the planning as far as implementation as well.
Martin, anything you want to add?
Yes. So, in addition to all those things, you talk about the strategy and overall mission, vision, and values of the organization. I mean, there are just some buy-sell partners that are not meant to coexist, and I've been a part of a number of those, where just the overall strategic view of the future of the organization is just mismatched. So I think that's a very important aspect relating to some of the items that Sasha's talked about. Part of the role of the CFO is really to determine the numerical side of some of those qualitative issues relating to the synergy model in the acquisition, what overheads are going to be eliminated, headcount pre, during, and post acquisition. And then ultimately the communication strategy of all of those items. In addition to that, you look at the two organizations that are going to come together, and do they have the same systems? Do they need? Does there need to be a major implementation of accounting software, sales, CRM packages, as well as insurance coverages? Do we need to add to one policy, throw the two policies out and start new? So all those considerations are factors that we would definitely look at and put together a game plan as the transaction date approaches.
Yeah, I would say that the culture piece is a piece that people don't want to talk about, and they just kind of want to think that it's just going to work, and it doesn't. And the reason why, the numbers are like, it's like 80% of mergers and acquisitions fail, right, for some reason or another. If you look deep into it, it's a lot of it's cultural, right? It's because you didn't communicate well with, and the communications piece is important. We were actually talking about it a little earlier. Like when you go to buy a business, you as the buyer want to get in as early as you can to talk to the employees and talk to people and let them know what's going on and give them a sense of comfort, especially if it's a bigger company buying a smaller company, because that smaller company mentality, they may not be thinking, they may see Big Brother coming in to buy them and they get a little scared, they get skittish, and you're going to start seeing a ton of attrition post-closing of employees. And that could be a huge problem as the buyer. You're buying this company, you think you're going to have this whole staff to do all the work, and it was never communicated well. It was a little family business. They were treated like family, but they weren't treated like family when it came down to it because the dad left. Dad sold the business and walked out, and he's on the boat, and he doesn't care. And nobody cared about me. Nobody talked to me about this. Nobody gave me any input on who was going to buy this place and who I'm going to work for. And now I'm supposed to go work for this company. So there's a big fight, that goes on. And I have this fight as a buyer's counsel a lot of, I want to get in. I want my buyer to get in. I want 20 days, 30 days ahead of closing. I want to be in there. I want to go sell the HR. I want to sell how great our benefits are. We want to talk about the culture and how great we are and everything there is. And the buyer's basically saying, you're not coming to talk to the seller's saying, you're not coming to talk to my people. There's no way. Because the seller's attorney's telling them, hey, there's too much of a risk. If you don't close, you really made a complete mess of your company. So there's a big piece that goes, I would say it's a fight that goes on in most transactions, especially on these smaller kind of deals, as to when you can get in. And there's no good answer, because the buyer side, I'm always going to say I want it early. Seller's always trying to mitigate that risk. So but it's a constant push, but it is part of the whole communication strategy that Sasha was talking about is if you as the buyer need to think about what's your strategy for how you're going to communicate, how you're going to get in there quickly and stabilize and make sure people understand what you're doing and why you do what you do. And, that's sort of the definition of culture for me is the why. And if you don't have your why in the acquisition strategy, it's not going to flow through to the culture. It's not going to flow through to any of it.
Thank you. So we're going to move, to be fair, to the sell side. Company Beta, sure everyone's shocked by that name, is a manufacturing company that has been consistently growing for the past few years. It's a second generation company, and the owner, who's the father, is semi-retired. They have 50 FTEs in 2 locations that include a main office and a warehouse. The owner's daughter has been working in the business for quite some time, and her brother has zero interest in working there. There was very little, if any, estate planning done so far, and the father wants to fully retire, and the daughter has said, yeah, I'm willing to stay on with the new owner for the right opportunity, but I'm also okay to move on and just do something different. In fact, she has a line of jewelry she started on Etsy that she could focus on, which uses CNC machinery for some very small and intricate pieces. They've decided to list with a broker. Now we're going to go with what's next. So our first question, I'm going to dive a little into an area kind of often not considered, and that's working capital. Some people are confused by it. So I'm going to ask the panel, what is it? And what are the requirements around it?
I can take this one first, I guess. Working capital is really the net difference between the current assets that a company has on hand less the current liabilities. And why is that number very important? Because that really tells us from an operations perspective what kind of capital is at the company's disposal to meet its short-term obligations and run its business. So as a CFO, we look at things like receivables. We look at things like inventory, in addition to cash and cash flow. And then on the liability side, we would look at things like the accounts payable to vendors and some short-term notes and other financing obligations that are short-term in nature. With small businesses, sometimes that's even credit cards. So it kind of varies from circumstance and situation to situation. With this particular hypothetical, we're looking at a legacy situation. So the question then becomes: does the existing company have the working capital necessary to properly transition the business from the owner to either the daughter or to the buyer? So from that perspective, we'll pass it along.
Yeah, working capital is something that I've seen almost blow up deals 2 weeks before closing. That people sign purchase agreements, especially when we're either stock or asset purchases, and the buyer is agreeing to, I know we're supposed to be vouching for the seller right now, but the buyer is always my client. So the seller is always convincing the buyer to agree to, I'm going to take all AR, all cash out of the business. You have to come and just figure this out, kind of. So as a lender, we're looking at this, all right, day one, this buyer is operating this business with no money in the bank, nothing coming in, everything AR, 90 days or less. They have to collect for the seller and give to the seller. How are they going to be able to operate this company and be successful? So as part of a lender's job, and anybody really advising in an M&A transaction, is you want to be setting up the whole transaction for success on the sell and buy side. So that may mean prepping the seller to be okay, you're going to have to leave some type of amount of collectible AR on the books for this buyer to be able to operate this business. Because if you take out everything, how are they going to pay their people? How are they going to take on new jobs? Same thing with cash too. So if most of their money is on 45 net terms, day one, they're not seeing those dollars for 45 days. So what cash are they operating with for those first 45 days? Now, if the seller is very adamant about not including that, then you can include working capital in the financing amount, or maybe they have outside funds they can bring in. But you really want to make sure that they have something to be able to operate with. And so we always do some type of working capital analysis. It's not always perfect, right? Because we're We're using the information that we're given from either the seller or the buyer, but something that's going to keep that business running for at least 60 days to give the buyer a little bit of time to catch their breath and start bringing in their own revenue for the business. It's a huge hot button topic. And then especially when you get into the net working capital calculations and that changing 90 days post-closing. That's another thing in SBA too, is you want to make sure in that purchase agreement, whether stock or asset, nothing in there is saying adjustment to purchase price. It automatically makes the whole deal ineligible from an SBA perspective. So there are ways to then, it's really semantics when it comes down to it. And you just say, okay, we're going to adjust the working capital, but the purchase price is staying the same. So as you get into some of the larger deals, especially if you're in, service-based businesses where there are accounts receivables and they're deciding who's getting what, a lot of times you see that adjustment to purchase price post-closing. Immediately, we can't even do the deal. So we try to get ahead of that very early on to prep them like, hey, let your attorney know this is a semantics thing. You can adjust working capital, but the purchase price must remain the same.
Yeah, I mean, if there's one piece that I would say is probably the least understood in the deal, it's the working capital piece. And it like Mary said, it is the one thing that blows up deals 2 weeks before closing consistently. And that's the fault of, the professionals around the deal, right? You didn't educate your seller or your buyer to understand what this really means, because when it's sitting in the purchase agreement, I mean, I write these, you write them, right? It's a hugely complex provision in the middle of an agreement that's 50, 60 pages long, and you're looking at it as the seller of the business and saying, I don't know what that means, and I don't really care. But you do care because it actually affects all of the whole transaction. So, I've been on the buy side. I was buying a company from my old company. I was a general counsel. I was buying a company, and the working capital was very clear. I wrote it. It was super clear. The seller went ahead and 2 weeks before closing, we saw the entire the bank account was just emptied. They took all the money, and he's like, well, I had to pay taxes, I had to pay this, I had to pay this. And I'm looking at it going, okay, now what? Now where's the money going to come back in for the working capital? Because you don't have any. Are you going to put it back in at a closing price? What are we going to do here? Because we're buying a business now that has no working capital in it. And my owner literally just blew up, said, I'm not part of it anymore. I don't care how good the deal is, and walked out of it and walked away. And I could not convince him that this was a phenomenal deal for us. And to this day, I will still say it would have been a phenomenal deal for us. But he walked out because the seller had taken all the cash and there was no discussion of how that cash was going to get back in, what it was going to look like. So I would say, trying to understand that piece of it as you're looking to sell or buy businesses is really important. So that's why I wanted to really make sure and I think Martin gave a great definition for it. You need to understand, it really is important to understand what working capital is, because when you're running your business, look, most of us run businesses here, day to day, your working capital is whatever I have in the bank and whatever I can, how I'm going to pay bills. I know I got a receivable coming in next week, and I know I owe my Amex bill, so I'm good. But, there's a lot more to it when you're actually buying that business.
One more thought as he was talking. It also will play into the valuation of the business. So if in the purchase agreement, most of the time a business valuation expert, they need that purchase agreement to complete the valuation, or at least like a very well-formed LOI. It's outlining, all right, there's going to be $300,000 cash, $200,000 accounts receivable for the buyer. That's then $500,000 that's going into that valuation. So if the seller takes all of that out prior to closing, you're buying something then that's $500,000 less. And so not everybody catches that until a couple weeks before closing, which we all don't want to do.
Great, thank you. So what are the steps required to sell your company, and what should you be doing to get your house in order ahead of time? Do you want to go first?
So we talked about a little bit about due diligence on the buy side, and the seller has to get their house in order. Mark and I always talk about this. So before documentation review, and to also look more legitimate for the buyer, you have to have your ducks in a row. We talk about having like a virtual data room, right? Making sure all your documents are there, up to par. We also have seen situations where there's just IT discrepancies between the buyer and the seller. So that's something the buyer is going to be looking at as well. On an operational standpoint, looking at your internal controls. Are there any internal weak controls? In the scenario we spoke about, we have 2 locations. And I've worked in companies where even if you have more than 2 or 3 locations, they're operating like different companies. What do the streamlined operations look like? What are the inputs and the outputs? How is that going to look on paper, financially, legally, and all the other different matters? So while they're going through the due diligence process, you want to make sure you have everything up to par as far as your documentation, tax papers, it's all IT, all the different things, insurances, cybersecurity is a big thing now. But operationally, we really look at how are things running efficiently? What do the resources look like? You can't go to the bank and get the loans and all of that if you're burning through resources. So that's what we look at, and we usually get the red flags by how the numbers look on paper, right? So that's what I have for getting your house in order.
Yeah, so we have a couple of realtors over here in the house. Would you? Yeah, he's looking around. He may be one. Would you go to sell a house or sell a building without preparing it? Would you ever think about selling your house without having the realtor walk through and tell you, you got to declutter your closets, you got to paint this, get your landscaping done? And people go to sell their business and they think that they can just sell the business without doing all that. You got to do the same thing, right? It's decluttering, and it's also, doing your homework, and it makes the deal a whole lot easier, right? So if you get a corporate attorney in and finance in to take a look at your books and your records and clean it up before you put your business up for sale, you're going to be in a lot better position than just going to try to sell your business and then finding out, oh wow, we haven't done minutes of the business in the last 10 years. Oh wow, our accounts are we have some messed up commingled accounts. There's a credit card that's a personal card that's sitting in the corporate books, right? All those kind of things you got to deal with, and dealing with them before you go to sale and put yourself up for sale is a whole lot better than we put ourselves up for sale and somebody came in due diligence and started to find all these things. Because, it's the nature of the beast, right? If you find one thing in due diligence, right, that was a little off, what are you going to do? Now you're in full mode because you think there's a whole lot more that's got to be off, right? So the whole transaction changes in terms of, I would say the wave of which way it's going to go. And then that's when the deals start to take a long time. And Mary knows this, and we all know this from doing deals. The longer it takes, the less likely it's going to close, right? Because there's huge seller fatigue and buyer fatigue in deals. Like it just grates on so long that you can't get that. Somehow some little thing will fly up, and that's when they blow up because it just took too long. So keeping the deal moving is really important.
Yeah, Mark and I just worked on a deal together where it definitely took longer than expected, not because of Mark, but because they changed the whole structure of the deal, like right in the middle of the process. And so if you're working with a financing partner, that's going to delay things because it changes the structure that you're underwriting to. And so as a part of like preparing the sellers and getting your house in order, you want to find out, okay, if I'm doing an asset purchase, we talked about contracts earlier. Can these be assigned to a new entity without having to go through a bunch of loops and holes? Because if those contracts go away, what is your buyer buying? Does he have to get an all new contracts? Are they going to go find somebody else? So we had to mid-gear switch the whole, and we were both representing the buyer in this case. So neither one of us did. But the seller didn't know until it came up that, you have to do a stock sale because these contracts cannot be assigned to a new entity. It has to stay a stock. And so getting your house in order, knowing, okay, what can be assignable, what can't be, that also prepares your seller mentally too, whether you're doing a asset or a stock purchase too.
And just to add, Mark and I had put for our prep for M&A, we have for the seller and also for the buyer a scorecard for questions for people to consider before they get into that process, because you have to be prepared to answer questions, right, when the buyer comes to the table and vice versa.
All right, thank you. All right. So what are some of the common structures to a transaction like this? There might even be an ask for an earnout. What is that? And are there certain programs that even allow an earnout in that situation? So let's start with like different ways you can structure this.
All right, so deals these days have all kinds of different stuff going on, and Mary can talk to the way the SBA is handling it, which is really interesting. And some of the new rules have made transactions super favorable for buyers and sellers overall to get done. So there's a lot of really cool things you can do now. But overall, like when you're going to structure a deal, the buy side versus sell side, obviously the sell side, you want cash at the table, right? I want all the cash from the barrelhead, show up at closing and write me a check and I'm gone, right? Unless you're staying in the business. Then you may say, oh, well, I'm going to stay in the business, so I may want some equity in it. Maybe I want to roll over and stay in the business, or I'm willing to in order to increase the valuation and get a better number, I'm willing to stay in the business and take some earnout, right? And these are all phrases that, people throw all this stuff around, and I don't always know if everybody knows what they all mean. So by show of hands, does everybody know what earnout is? It's pretty good, but there are some people that don't know what earnout is, so if you don't know what it is, it's basically you're saying, I'll sell you this pen today, and you're gonna buy it for $1, plus you're gonna use this pen for the next 5 years, and you're gonna earn money on it. So I'm willing to take the risk that you're gonna earn more money from it, and you're gonna pay me some of that money as you earn it out, right? So it is really like understanding the structures of the deals is really important, right? Because it changes it changes the valuation overall. And so all these things are all interconnected, right? The stock purchase, the asset, or is it a stock purchase, is it an asset purchase? Is there going to be earnout? Is there no earnout? Is it a seller note? So is the seller going to hold the paper, right? Which may help in financing the transaction, right? Because maybe the buyer doesn't have all the cash they need to do the deal, and maybe the seller can hold some of the paper. The seller's saying, hey, I'm selling my business for $5 million. I don't really need $5 million today. And from a tax perspective, it may be better for them to not take $5 million today. Maybe I take $4 million and I'll take a note to earn the rest of it out, and I'll get a good interest rate. If I get an interest rate at 8 to 10%, I'm probably beating I'm beating what I'm probably going to do in the market anyway. So it's not a bad gig, as long as you have some guarantees on that you're going to get paid. So all these things start to factor into each other, and as you're trying to structure the deal. And I say, the earlier you can sit down and kind of, engineer the deal from the beginning, as opposed to a lot of times I get brought in and the deal's already kind of engineered, right? There's already been a bunch of discussions between a seller and a buyer and a broker, and maybe an accountant was in, probably not, and maybe the banker was in, probably not, and people came up with a deal, and the structure may not be the best structure for the seller and the buyer. And then there's the tax piece of it throws the whole thing into a tizzy, right? Because there's a tax consequence on both sides of how you structure these deals. And so we structure deals. I do a lot of seller buyer. I do a lot of like shareholder buyout stuff where one shareholder is just trying to buy the other one out. And some of the stuff that you see there gets really crazy. We're doing stuff with deferred comp now on shareholder buyouts, just because it's the only way to get a deal done because there's no cash. So there's all kinds of weird things you can do. But I mean, Mary can talk to the sort of the way you guys handle it from the SBA side.
Yeah, for sure. So earnouts, if I see the word earnout in a purchase agreement, I also can't do the loan. So those are also ineligible. However, we have to look at it from like an opposite perspective. So we always have to look at it because at the end of the day, yes, we want that seller to be happy, but our buyer is our borrower and who we are lending to. So we have to look at it from the buyer's perspective. And so instead of an earnout, what can be used in place of that is a forgivable seller note. So it's kind of like the opposite, where let's say you're buying a business for $4 million and but you're only getting the seller $3.5 million cash at closing. So they're going to hold a $500,000 seller note. In a situation where that 500 would be an earnout over time based off of whether it's top line revenue or EBITDA. I've seen them based off of both. Most of the time I do see gross line revenues because EBITDA can get a little hard because it's how the buyer manages the business, right? And so that $500,000 seller note in lieu of an earnout would be a forgivable seller note. So I was just looking at an electrical company this morning where instead of if 2023 numbers do not pan out over the next 3 years, like within a percentage, right? Let's say it's within 5 to 10% of top line revenue, then portions of that seller note get forgiven. And then over time, they could get all of it forgiven. So instead of an earnout, it just gets forgiven. So I know it's a little bit of a confusing concept, but you just think of it backwards where instead of the seller earning money on that, if the company is not producing as well, they're just forgiving portions of that seller financing. Does that make sense? And so we've gotten really creative recently with different deals where you can have multiple seller notes too. So you can have one that's structured as a forgivable note, one that's a regular, you're paying it day one from closing P&I, and there's no weird forgiveness in it. And so it really helps both the buyer and also that buyer's lender feel comfortable because that's going to show too that the seller is invested in the business. And if the buyer needs something, they're going to pick up the phone, right? And they're going to be able to help them get to those numbers because why would you want to forgive that type of money? And so then you can also, it accrues interest still. There's nothing wrong with it accruing interest over time. And then there's, speaking of structure and everything, so there's now a lot more flexible ways the seller can do that financing. So historically, before last summer, the only way a seller financing could count as equity injection if it was on standby for the entire life of the loan. So what that means is if I'm a seller and I have a $500,000 seller note, I don't see a penny of that until either the SBA loan is fully paid off or it's refinanced. So that can be like a hard pill to swallow because that could mean 10 years of waiting for my $500,000. Depending on the age of your seller and what they want to do, lots of sellers don't want to do that. And so now they've made it more flexible where that still counts, and we love that, right? But we know that that's a hard pill for the seller to swallow. So you can also do 2-year standby, and then it amortizes out over time, or 2 years interest only, and then it amortizes out over time. The trick there is it must still cash flow during that amortization period with your senior SBA loan. But that really opens up the buyer pool now to and sellers, because if I'm a seller, yeah, I'll take 2 years interest only on something and then it amortizes out for maybe 5 afterwards. You're seeing your money a lot faster than it would be on standby. And on top of all of that, the SBA is even allowing sellers to do that for up to the full 10% of the equity injection. Now, good luck finding a lender who will do the full 10% with the seller financing it. Unless in certain circumstances. So our firm, we have been looking at, we will do that 10% fully seller financing if it's a key employee or management buyout. So let's say, the seller has been kind of absentee the last few years. Somebody's been running the day-to-day. They now want to buy that business. But they just don't have the real money equity. We'll call it sweat equity. We'll finance that 90% SBA loan, 10% seller note. So it really opens the pool for buyers too, because now you can only put anywhere from 2.5 to 5% down. It just creates a lot of creativity in terms of structuring, depending on what your buyer's liquidity is. And right now, we all want to protect our buyers' post-closing liquidity because we also don't want to drain them of everything they have to buy this business. So it's just really cool and it helps. So I get into the weeds with it because I'm excited about it because we can do a lot of different deals that way. So let me know if you have any more detailed questions later, or if you do now. Is that okay? Yes, and good distinction, because I just talked with an escrow attorney about this who was going to pre-file the UCCs on the 2 seller notes. And I was like, no, don't do that, because then we can't close until those get unfiled. So the SBA will have to be first lien UCC, but they can take a second lien on the business assets. So they can still take liens and guarantees. It would just have to be in second position.
Great, thank you. So last question, because we're kind of coming to the end here, but business is personal. Sounds like the father's owned the business for a while. More generally, what should an owner be thinking about when they decide to sell? What are some of the things to consider if you're choosing to sell, particularly with the history that they might have? Martin, you want to go first?
Sure. Yeah. In a family-owned business, as this hypothetical is, from the owner and founder's perspective, obviously there's a lot of emotional ties to this business. And the first and foremost question from the owner is really, where's my baby going, right? Is it going to go and get into the hands of, family? In this case, the daughter's interested, but the son is not. So that is one option. Having the daughter still continue to participate in the business while selling to somebody else is another option. And then selling to a third party altogether and exiting the business, for the entire family, certainly are the options that are on the table. From the owner's perspective, you've got that legacy issue. You also have, in this case, the emotional and financial aspect on an individual level. So the owner, the father, he's going to retire. So how is he going to live in retirement? What kind of income is going to be derived? Is he going to live off of just the corpus of the proceeds from the sale? Or does he need earnouts or other stipulations in the deal to help support his lifestyle post-transaction? There's that consideration, and we've talked about taxes a lot. Uncle Sam can rear his ugly head every once in a while, and certainly when you have a large sum of money exchange hands, Uncle Sam wants to have his piece of the pie. So, the final piece of the puzzle is cash flow, both from the company's perspective and from his perspective, and making sure that the business can sustain its cash flow, and especially if there are earnouts and other stipulations that would ultimately benefit the owner post acquisition. So, the CFO as the advisor in that kind of capacity is really trying to put all those numbers together and hypotheticals together, and ultimately lay down how the alternatives potentially could play out based on reasonable forecasts for sales and earnings, and certainly the leverage and financing structure that's in place and will be in place post transaction. So those are the decisions that he or she might have to make.
Yeah, I mean, when you're dealing with, second gen and first and second gen businesses, I would say the first thing you want to try to do is you want to try to get an estate planner or a financial person involved into it, so that they can help them kind of understand here's the lay of the land and what it could look like for you. And, like I think what Martin said is, what do you really need in retirement? If that's what your goal is to get out and retire, what do you need? And a lot, it's amazing, most of us, we don't like to think about the end of our lives and where that's going to go. But if you don't start thinking about it as a business owner, before, your succession plan, what's your overall strategy? What are you looking at? And having a financial plan to do that, it's critical, and it changes the whole scope of what the deal is going to look like and what you can take and what it's going to take to get you out. And, when you have a daughter that may want to take the business, may is never a good term, right? You want them to want the business, right? They should want to be involved in it. And if they're basically saying, yeah, I'd stay or I don't want to stay, they kind of told you what they really want, because they don't really want to do it. And if they don't really want to do it, it's not going to be successful. So you have to take those hard decisions as the father, looking at it and saying, okay, well, I'm going to make the decision for them because they don't really want to do it.
So to piggyback off of Martin and Mark, looking at the why also, as far as why he wants to sell. In this case, he's getting older, but I've heard of deals, people backing out last minute because they changed their mind. It's usually a big one. And also on the cultural tip, besides financial retirement, culturally, what kind of company is he looking for as well? Because sometimes people also have a tie to the people that work for them. So we don't want to just sell to anyone. So I think it's always good to have an idea ahead of time of kind of what do I want my buyer to kind of look like, and what kind of culture do they have. There was one lady who I know inherited a business, and she completely modernized the business, and people within the company were not ready for it. But having an idea, if the daughter does take over, what does that look like for the new buyer? So that's usually a big one. And also, like you said, if she says she doesn't want to be a part of it, there's your answer. But if she does, what does that role look like? Because at the end of the day, you're going to have subpar performance and involvement if someone really doesn't want to be there.
First, want to thank the panel very much. Thank you for sharing. I'm sure you could have gone on for hours if you wanted to, but thanks for sticking to the schedule. And thank you all again for attending.